Humanity has treasured gold for thousands of years. It never rusts, it doesn't decay, and because the supply is finite and can only be mined slowly, it has become the default asset to hold when trouble hits. Whenever global stability falters, investors rush in. Notice the sharp spikes during the 1979 oil shocks, the 2011 financial crisis, and 2020 pandemic. By late 2025, rising national debts and inflation fears triggered a massive rally, making previous crises look like minor ripples. Centuries of financial history suggest a clear rule. When the world panics, a gold rush is almost certain to follow. In January 2026, that rush hit its peak. Gold broke $5,300 an ounce as people queued around the block to buy into the rally. Then, in late February, a major conflict broke out between the US and Iran. The fighting immediately disrupted the Strait of Hormuz, the single most important artery for global energy. By every historical measure, gold should have skyrocketed. Instead, it fell off a cliff. By July, the price had shattered the $4,000 threshold, collapsing more than 20% even as the conflict intensified. The world was in a state of high-stakes panic, yet the ultimate safety net had failed. Why did the safe haven trade break down exactly when it was needed most? Understanding this breakdown requires looking past human instinct. Gold's price is actually the result of a ruthless tug-of-war of four specific economic forces. On one side, forces pull the price up: geopolitical fear and inflation expectations. People buy gold as insurance. But on the other side are two heavy anchors: interest rates and the US dollar. When these rise, they make gold less attractive, pulling the price down. The price of gold isn't a measure of safety. It's simply the scoreboard showing exactly which of these four forces is winning the tug-of-war at any given moment. In 2026, the Middle East conflict choked global shipping, leaving massive tankers dead in the water. This caused energy and oil prices to skyrocket. While that energy shock created massive inflation fears, it also triggered a systemic reaction that investors didn't account for. To stop that war-driven inflation from spiraling, the Federal Reserve pivoted. Officials signaled they would aggressively hike interest rates to cool the economy. The same geopolitical crisis that spiked inflation also forced a central bank reaction that completely neutralized the fear incentive to hold gold. This reaction was so devastating because of gold's biggest vulnerability. It pays no dividends and generates no interest. It is a sterile asset. When central banks raise rates, boring assets like government bonds suddenly start paying investors a guaranteed high return. Investors will always choose the asset that pays them over the one that just sits in a vault. Additionally, those higher rates supercharged the US dollar. Since gold is priced in dollars worldwide, a stronger currency makes it significantly more expensive for international buyers to purchase, further killing demand. The mathematical gravity of rising rates and a strong dollar will almost always outweigh the emotional urge to buy in a crisis. The 2026 crash primarily hit retail speculators, who panicked and sold their holdings at a loss as the price dipped. However, major central banks, led by a coalition of foreign nations including China, ignored the short-term volatility. They used the crash as an opportunity to continue aggressively buying gold at a discount. While the headlines focused on the price collapse, the institutional players were focused on the long-term trend, proving that short-term panic often masks a very different reality. The events of 2026 demonstrated that headlines and explosions rarely dictate financial reality. When the next global crisis hits, look past the news footage. Watch the central bank policy and the movement of interest rates. That is where the real market story is told. The invisible mechanics of money remain the most powerful forces ruling the global market. To see how professional investors actually trade these massive swings using derivatives, watch our next breakdown, linked right here.